On May 12, 2026, the Bombay Stock Exchange saw the Sensex plummeted 1,500 points in a single session. By the closing bell, 12 lakh crore rupees in investor wealth had simply vanished. At the same time, the Indian Rupee fell to a historic low of 95.63 against the US dollar. This collapse appeared at odds with the broader data. Just weeks earlier, the economy was reporting 7.6% GDP growth, supported by strong manufacturing and services sectors. While the numbers suggested a domestic failure, the actual trigger was pulled 3,000 kilometers away, revealing how a regional conflict can instantly reach into the Indian economy. Escalating tensions between the US, Israel, and Iran had moved toward the Gulf, placing global shipping lanes under immediate threat. This is where India's math becomes a liability. The country relies on imports for 85% of its crude oil, and a significant portion of that supply must pass through this single, narrow waterway. This reliance means that the security of foreign waterways is now a prerequisite for India's internal economic health. This chart shows the market reaction to those tensions. Fears of a supply blockade sent Brent crude prices climbing past $107 a barrel. Because crude oil is traded globally, India has to settle its massive import bills strictly in US dollars. To get those dollars, Indian oil companies must sell enormous amounts of rupees. This floods the market with the local currency, which drove its value down to that record 94 mark and beyond. This creates a widening current account deficit, where the cost of necessary energy imports begins to outweigh the capital coming into the country. Foreign portfolio investors monitor this currency volatility closely. When the rupee drops, the value of their Indian holdings decreases in dollar terms, often triggering a move to pull money out of the country. This coincided with disruptions in the IT sector. As OpenAI expanded into AI-led services, investors grew cautious about Indian giants like TCS and Infosys, leading to a coordinated sell-off. This exodus of capital led to the 1,500-point drop in the Sensex, as foreign funds converted assets back to dollars and exited market. An energy shock in the Middle East doesn't stay confined to oil. It moves through the currency directly into domestic company valuations. By April 2026, the Reserve Bank of India's Monetary Policy Committee was forced to address the growing instability. The bank was caught in a policy trap. Cutting rates to help the stock market could cause inflation to rise even faster, but raising rates to protect the rupee could stall domestic growth. This chart projects consumer price inflation rising into the third quarter. Facing the threat of stagflation, where prices rise while growth slows, the RBI opted for a wait-and-watch approach, leaving the repo rate at 5.25%. This left the central bank in a state of paralysis, unable to deploy standard tools without risking a worse economic outcome. For the average citizen, this macro-level crash arrives first at the local petrol pump. Higher global oil costs and a weaker rupee create a combined pressure on fuel prices. This leads to broader costs, including a widespread LPG shortage that impacted households and the hospitality industry throughout early 2026. The impact extends to education as well. For Indian students studying abroad, an 11% depreciation in the rupee makes tuition and living expenses instantly more expensive. Ultimately, these currency shocks function as a tax on the public, increasing the cost of daily life long before the effects show up on a corporate balance sheet. The events of 2026 demonstrate the vulnerability inherent in India's current energy foundation. Navigating this requires a shift toward diversifying the energy grid, expanding renewable capacity, and increasing strategic petroleum reserves to insulate the economy from price spikes. Until the country achieves energy independence, the economic security of over 1 billion people will remain tied to the